Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, April 8th, 2015. In this video, I wanted to take a look at the U.S. Markets, major U.S. exchanges such as the S&P 500, the Nasdaq, via the QQQs. We'll take a look at the small caps as well. And in this video, what I wanted to do is start out taking a look at some trend indicators, both long and short term, and then we'll roll into the charts, looking at the actual technical, posture, trend lines, chart patterns, etc. So what I'm looking at here is the what I refer to as my quad trend indicator. This is a chart I've shared many times over the years on the site. It's actually made up of four different charts with four different time frames. I'll touch on those real quick and then we'll zoom in and take a look at each one. This is one of my daily short-term trend indicators. So what that means, it has a daily time frame chart. It's a 2-year chart of the SPY. We can plug in any index or tracking ETF that we want. It works pretty well on just about all the U.S. markets. I'll get into all the details in a minute. Over here we have the daily intermediate trend. So this is a shorter term trend, giving us those short term get in, get out signals. When we go to the intermediate trend, we're still using a daily time frame, except what we're looking at here is the 20 and 50-day moving average, exponential moving average pair, which, as I've talked on in the past, has done about as good a job as any, especially for a very simple trend indicator. By simple, I mean we're just using two moving averages. We're not using a trio. We're not using multiple sell signals. And of course, as I always say, there isn't any one trend or buy or sell indicator by itself that's perfect. So I use these in conjunction with other confirming signals to help define the trend, or try to help minimize those times where some of these trend indicators can give you a whipsaw or a false sell signal or buy signal. Moving up here, this is the weekly time frame, weekly chart using a 1743 EMA pair, and all the way over to the monthly trend. So let's just start out on the long term, because we're not going to need to spend a lot of time on that. So let's zoom in on this chart. Okay, so now we're looking at a monthly chart, meaning this is a monthly time frame going all the way back to, looks like 1988 here. So way back in time, spanning many decades. And, as I said, as I talk about here, simple but effective. We're looking at just a pair of moving averages, in this case, the 10 and 6 EMA. So again, that's on a monthly chart, that's a 10 period and 6 period monthly average exponential moving averages. And what I've done down here is I like to create these custom histograms, and all this does is simply notify you when the 10 EMA is trading above or below the 6 EMA. So when you see the histogram cross positive, which are the green bars, down to negative, that's simply showing you, if you follow the cursor up, when the crossover occurred. You can zoom in and see. So that's all that is. It just gives me a quick visual representation, because when you're looking over a 20, 30-year time span, these lines, especially you watching this on a YouTube video, probably appear very close together. So here's a quick visual indication. And I also get these histograms give me a nice indication of when that pair is peaked out. And if you look at, for example, this was the bear market back in, that started in 2000. Here's a signal that was triggered. It looks to be about towards the end of the year, around November or so. And of course, the market peaked earlier that year in 2000. So when using these longer term time frames, they're anything but an exact timing indicator. That's why we have the shorter term trend indicators, and that's why we use those in conjunction with other things such as trend line breaks, pattern breakouts, etc., to help confirm and get in earlier. But if you look at the effectiveness of this, again, we're going back almost 30 years here, and as you can see, for a long-term trader or investor, just simply going off this, being long when this pair is on a buy signal, and then getting out, did it get you out the exact top? No, but it got you out pretty darn close to it and kept you short throughout most of the bear market back in 2000 to 2003 and put you back in here, as you can see. Kept you long through the entire bull market, or the bulk of it, I should say, which ended in late 2007, and then got you out pretty darn quick in time. So again, very effective indicator. I also use that in conjunction with this ROC 12. Tends to work well, especially on the SPY on a monthly time frame. And as you can see, that's another additional way to confirm. So where are we at today? Well, we're not even close to a long-term sell signal yet. We do see, as you notice here, the histogram has been steadily declining, meaning that the momentum in this bull market has been waning. Just as with every other top, you can look at the peak here. It really coincided with the peak of the market. Here's a peak here, market top there. Actually, the market top just slightly after, but we made a divergent top. So, in other words, you get the point that this is declining, and by the time we realize that we're most likely in a bear market, this longer term signal will come in and confirm a little bit after that. But at that point, you can say with a pretty high degree of certainty, barring some very small whipsaws. If you can see close enough, there's a whipsaw signal right there, whipsaw signal there, but they only lasted very briefly and they were very shallow. So once you start seeing this indicator roll over, odds are you're looking at several more months of a bear market, but right now we're in bull market territory. Okay, enough of that. We all pretty much know that the overall trend is still positive at this point in time. So now let's take a look at the weekly time frame. Let's see here, maximize that. Okay, the weekly time frame. Now, as we move down to shorter term time frames, you'll have quicker signals. In other words, you're going to have a sell signal come earlier, and your buy signals will also come earlier. However, the downside or flip side to that is it does lead to a little bit more whipsaw signals. With that being said, this also is a very effective, highly effective indicator. We're looking at a 10-year weekly chart, so this one goes back 10 years, using again the 1743 EMA pair. And if you simply look at the crossovers here on the histogram, you follow the lines up. The black dotted line that you're looking at is the S&P 500. So, not bad. Better than just about any analyst out there can call it. And here's something that you can replicate on your own computer. The move off the bottom of the 2009, the bear market that ran from 2007 to 2009 was explosive, and it was a V bottom, a very rare V bottom recovery because we had fallen so hard. So, we'll say that this one didn't get you in really close at all to the bottom. However, it kept you out of the bulk of the move. It definitely would have saved a long, even if you're not a short side trader. It would have allowed you to, book profits and go to cash at that point, and would have told you back sometime in, looks to be about September of 09 to get back in, and since then stay in. Other for this correction, we did have a very powerful, sharp correction, which if I recall right, even equated to a bear market in the Nasdaq, which was a drop of over 20%. But on the SPY, we fell just short of that. Either way, that was some very choppy, ugly price action, and this indicator would have got you out at that point, and then put you back in early January 2012, and clearly kept you long since. So again, this is what I call my weekly long-term time frame. So the weekly, the monthly trend indicators are clearly on buy signals, although we do see the momentum waning. You can see that really that EMA pair peaked back here and has been slowly closing in. And what I mean by that is the 17 EMA, the distance or the gap between the two is closing. And although you may not be able to notice it clearly here, that's what the histogram points out, because the histogram is simply showing the difference between the two. Okay, let's go ahead and move on to the daily time frame. Okay, this is what I refer to as my daily intermediate term time frame. Let's see if I can center this a little bit better here. There we go. And this is again a very simple but effective pair. This is the 20 and 50-day exponential moving average. We're looking at a 2-year daily time frame chart of the SPY here, and you can see here we had a couple sell signals in recent years. Now, given this one has been, especially in the last couple years, not as effective as it has been historically. On TC2000, there's some limitations. You can only go back on a daily time frame 2 years. So I'm going to flip over to another charting platform and show you a longer term track record real quick here. But as you can see here, the warning signs were there. You can see a divergent high. I drew divergence here on the moving average pair histogram, and although it's not drawn here, if I were to add a trend line, not on the moving average pairs, but on the actual market itself, the SPY, the S&P 500, you'd see an upsloping trend line there against a downsloping trend line on the histogram. That is negative divergence, which was immediately followed by a very steep and sharp correction. The moving average pair itself came late. It really gave that sell signal right about the time the market had bottomed, and therefore, had you gone short, that would have it did prove to be a whipsaw signal. The market rallied back up. But again, we had another divergent high here. You can see prices moving higher. The S&P 500 making a higher high with negative divergence there. And this sell signal got you in a little late again, but enough. If you look at when it crossed here, I'm holding the crosshairs. That was about the first week of October. It still got you short enough that was a sizable drop. Percentage-wise, that was about 3.5%. And but as the market has done in the last couple of years, we had a very, very sharp rebound and recovery. So again, the track record on this, as far as timing indicators, has not worked that well over the last couple of years. But let's take a look at a little bit longer term chart. This is on stockcharts.com. I've pretty much replicated the same thing here, custom histogram using the 20 and 50-day moving average pair. The chart up top, very subtly you can make out the S&P 500. This is the SPX underneath, but the moving average pair right here is the red line, which is the 50-day exponential moving average, and the blue line, which is the 20-day. And down below is the S&P 500 again. So you can see the price here, the histogram, which again helps us clearly point out those crossovers, bullish and bearish. So anytime you see the green lines, the 20-day was above the 50-day, and in this case it's sort of like I didn't use red, it's sort of a brownish color that shows the bearish crossovers. And what I'd recommend, I'm not going to sit here and go through each one of these. You can pause the video here and take a look and notice how what I did is I put the red line showing the bearish crossovers, these horizontal red lines, and then the green line showing the bullish crossovers. So if you simply take a look, and again, we're going back a lot longer in time here. This goes all the way back through early 2006. You can see how it did do a good job. Got you long here. There's a long uptrend. Got you short. Caught a little bit of the short move. Told you to go long again. Nice uptrend. Long. Let's just look at the long entries here, or some of the big short entries, I should say, as well. There's a short signal. Got you in the bulk of that move. Got you out right after the bottom. Got you long. Put you short again. Long. So you get the picture. Here's some of the bigger uptrends in the last few years, and this one is really almost unprecedented. This is, has a lot to do with quantitative easing. Everything the Fed's been doing, the central banks have been just keeping the gas pedal pressed down, and that's why you haven't had really any signals. But then again, it's done a good job of that, telling you to stay long the whole time. They're very, very brief. There's a very brief whipsaw signal there I didn't include because it was so small. You couldn't even put the two lines next to each other. It only lasted a day or two. And then this was, again, here's the last couple of years. As I showed you, in the last couple of years, the sell signals weren't that as effective as they were in the past. But that's why I wanted to zoom out and show you this longer term chart. and let you know that this is something I have not given up on. And jumping back to the other platform, where we're at today, why I point this out is sooner or later, the accuracy of this moving average pair it's going to come back or revert back to the mean, which means when you get a signal, it's going to be a tradable sell signal. And if you look at the pair right now, we'll zoom in. Well, first of all, you see the divergence that I've drawn here since December. That moving average pair has peaked, and we hit a high here back in the market as well as in that the histogram on that pair. So if I were to draw a horizontal line from here to here, like this dotted line, that is clear negative divergence, number one. So that should warn us that this correction that we've had so far, I think it's only the beginning of a much larger correction. Not to mention the moving average pair is currently poised across. We have had, as I said, in the last few years, we've had a couple bounces off that level. Sometimes the 20-day moving average comes down and kisses the 50-day moving average, and that acts as support, and then the market goes on to rally. That's happened back here. It's happened to several times. We've had a couple, brief breaks below, but because of the fact we haven't had a sharp correction in some time, my guess is this is going to be more than just a kiss. We just recently had a kiss back here. I doubt we're going to have another kiss this time around. Again, and a lot of this has to do with the other factors that I'm looking at on the chart. So let's go ahead and move on. Okay, and then finally, let's zoom into this is the daily short-term trend indicator, and there's actually three different things on this particular chart. There's other trend indicators that I use, but on this one of the most simple is the 20-day moving average, the exponential moving average 20-day period on a daily chart. That's a blue line, and it's as simple as this. When the slope of that line is up, meaning the line is pointing and moving up, you're in a bullish trend. Once that slope turns down, which it did back here, that 20 EMA has been moving lower since and pointing lower. That's sell signal number one for, again, very short-term trend indicator, and it's worked pretty well. You can, of course, take a look, pause the video, take a look at this. You have a divergent top here on this pair. Now these moving average pairs aren't shown above. I don't have the moving averages up top. I don't want to make this chart too busy. So I just simply use the histogram. This is a 13 and 39 exponential moving average pair plotted against the S&P 500 as well as a 2613. They both do pretty good jobs of, if you look here, just follow the horizontal line. Both of these triggered a sell signal there about the end of, if you look in the left-hand corner, the end of September. And got you in pretty good. Got you short here and helped confirm, we were short at the time anyways, and we were short ahead of that, but that helped confirm that move. And, I don't always use these as exits. Typically, as most of you know, I'll have downside targets that are based on support, horizontal support levels, Fibonacci retracements. I'll look for divergences and other things. So, while you could effectively just simply trade this, and do well and outperform the market based on, all these trend indicators that I've shown you, I think when using in conjunction with other signals, it tends to get you in earlier and helps confirm the trend once you're in short or long, and then helps, often can help with your exits or help confirm your exits. But again, I think they work better as signals to get long or to get short than as exit signals. Okay, moving on. Let's go through the index charts now. Look at chart patterns, price action, trend lines, etc. And I'll do this relatively quickly because most of these charts you can access via the live chart links page. These are all on stock charts. So you have links to these. I keep these updated. If you ever notice a chart that doesn't seem updated or some of the information's pushed off to the side of the chart, that happens. Long story, but you have to continually update these links and refresh them. Even if I'm keeping these charts up to date on my end from what I'm seeing on stock charts, the links that they give you don't update automatically when I change any settings on the chart, such as a time frame or anything like that. So just drop me a line if you notice a chart doesn't look not displaying properly or doesn't look up to date. I'll go ahead and make sure I update the link on that. This is a several years. It's looking at a four-year chart on the S&P 500. Again, this one's also on the home page on the link to the S&P SPX daily chart. This is a trend line that goes all the way back to October of 2011. Worked very well. We had this breakdown. This looked like the real deal at the time. The S&P 500 broke down, but the QQQ NDX managed to hold on to their longer term uptrend line and failed to make a weekly close above it, or I should say below it. Since then, what we've been doing is prices have been limping a little bit higher, working their way higher, not very impulsively. We had an impulsive move after the sell-off, but since then we're almost flat, really, looking at it year to date. If not maybe negative, I haven't checked the numbers, but we're right about there because this is where we close the end of the year. The dashed black lines here, they represent a possible broadening wedge pattern. Prices have been crawling up the top of that broadening wedge pattern. And this blue minor or sub-uptrend line, that's a line to watch. So I think if and when the S&P 500 breaks below that line, which I expect it to do, we have some downside. I don't really have any official targets on here. These are some horizontal support levels. But I look at, as most of you know, I put a lot of emphasis into these divergent highs. And if you just look at the track record going back here, here is another divergent high. You can see the corrections that have followed these divergent highs. And I expect nothing less following this one. So my guess is the S&P, at the very least, is headed down to this $1,900 or 1900 level. Of course, pending a break, below this minor uptrend line, I should clarify. This is a weekly chart of the S&P 500, also on the live chart links page. Again, very simple but effective stuff. These divergences, we had a divergent high back at the end of the bull market in 2007, divergence both on the RSI and the MACD. We had positive divergence. It's not drawn here. I'd have to oops, that's not going to work. I'll have to add a annotation here with the screen draw tool if I can find that real quick. But there's a divergent low there. I did have it drawn marked here and as well as here on the RSI. So, these divergences work both ways. I like to see positive divergences to indicate a reversal to a bullish trend, and negative divergences that foreshadow a correction or a downside move. So we've seen the corrections, divergent high. This one worked out for a very nice correction. This one worked out for, these are all tradable corrections. And we have this, what I call double divergence. We have the divergence here. It became even steeper here as the S&P has continued to wedge higher. You can see that the momentum is waning. We used to have these very impulsive thrusts, these big moves up after the corrections before. And we've had nothing but a steady grind, low volatility, and those are usually the moves that lead up to a big, nice, sizable correction. So as I said, at the very least, I'm looking at a move down to 1900. Now keep in mind, even if we go really any lower than where we're at now, we're going to break this multi-year uptrend line. When I say multi-year, this is defines the bull market off the 2009 lows. So we break that trend line. I do have this dash trend line that is a little bit below there. We might find some support on this one. But again, right now, most of my focus is on the Nasdaq 100. This is the Nasdaq Composite, not the Nasdaq 100, but the Composite. Bearish rising wedge pattern there, divergent top. Once again, these are the corrections that were marked here in percentages. That was about a 12% drop after this divergent high. This chart goes back to late 2011, by the way. So there's a drop, about a 10% drop following that divergent high. And this is my minimum downside target here. I'm looking off the highs about a drop of about another 10%. I think it says 9.6% or something there. So what we've had is a breakdown and backtest. Yeah, I've been pointing out this rising wedge for a while on the Qs as well as the Nasdaq Composite, and prices have broken down. And if you really zoom in closely there, it might be hard to see on this chart. We've been crawling up and backtesting underneath there, so I do expect a resumption of the trend. And as I've been stating, really for over a month now, um, I think we only have about 3 more weeks to get there. So I do expect the selling to kick in pretty sharply soon. This is the NDX, Nasdaq 100, just the top one, largest 100 components of the Nasdaq. So obviously the chart will look similar. You can see a little bit better here these black lines defining this rising wedge pattern. T1 is that $4,100 level, which correlates to the $100 price level on the QQQs. And as you can see here, divergent high confirming that bearish rising wedge. When you have these divergences in place, it really greatly helps to confirm a downside break of a bearish rising wedge pattern. So again, look at the history. You can, as these arrows point, every single divergent top on here was followed by a correction. So will it be different this time? I'm not betting my money on that. As I mentioned, I'm short and will remain short and use this recent strength in the last few days to add to my short position in the Qs. Now here's something I haven't talked much on lately, but I do expect a nice sell-off. The Russell, face value looks bullish. We had this, triple top high, 1, 2, 3. I was expecting a downside break, and we did get a downside break of that range. We hit that. These are all price targets that I had in the past. We had this price target here hit. Back here, I had actually 4 price targets. We went on to hit the second of 2. I can't recall exactly where we were short, somewhere near the highs on here. And I expected more downside, and I still think we're going to get that. Now, what happened is that this was the base or the bottom of that at the time a double top pattern. We broke down, hit that second target, and then this is when the markets, they just turned on the machines, and it was just gunned higher, and the S&P, the QQQs, the small caps here. And what we did is we went on to then make a triple top and broke above it. So on face value, that is a very bullish technical event. I'm sure most people see it that way. I see it otherwise. I see it like as a breakout that's very likely to fail. And as I often talk about, fewer things are more bearish in trading than when a bullish technical event breakout. Like for example here, a breakout to new highs, especially above a triple top resistance pattern, if that were to fail. Why do I think it'll fail? Well, among everything else I just talked about on the trend indicators on the other U.S. broad markets, as well as this bearish rising wedge pattern here. This is a nice, clearly defined. We have this divergent top here, negative divergence confirming that bearish rising wedge pattern on the Russell 2000. We're right at about the point, getting close to apex, 70% give or take into the apex of a wedge is usually where it will break down if it's going to break down. And so if that does break down, this pattern would measure well below that former triple top support level here. It's hard for me to make out on this chart. Call it 1210 or so. So if and when prices go below there, that will have proved to have been a bull trap. A lot of people that bought the breakout here, looking at Russell breaking out to new highs, especially if we see a sustained move lower. So I do think it's very possible at sometime this year in 2015, I think we're going to see a heck of a correction in the equity markets, and that's why I've left these targets on this chart, because I wouldn't be surprised to see these further downside targets like T3 at the 1010 level, possibly even that T4, that former T4 level around 952 to be hit later on. But first things first, and we need to see a breakdown of this bearish rising wedge pattern. Okay, guys, I mean, you get me talking about the stock market, I can I usually don't want to shut up, but I can see this is running into about the 30-minute mark here, so I'm going to wrap up with this chart. There are quite a few others I'd like to cover, especially some of the global or international exchanges, but for now we'll just leave it here. Let me center this a little bit. I just covered the Russell 2000, which is, in my opinion, the most widely watched small cap index. This is the S&P 600 small cap index. So another, just a different variant, another index of small cap stocks. This chart is a little bit more clean than the one you were just looking at. So let's just take a look at this and what we see here. Here's the uptrend line. The blue uptrend line is off the March 2009 lows. Very well defined uptrend line. We have this initial tag here, another tag there. I mean, these are perfect touches. Third tag, fourth tag, fifth tag, and then a breakdown. Impulsive selling following that breakdown, which helps confirm or validate that trend line. Since then, we came back up, we back tested, failed. Back tested again, failed. Yes, we've been moving up higher, but we're still below that trend line. And then we have two other technical developments that have set up since. Like a lot of the other indices I just pointed out, these black dotted lines represent broadening top pattern or broadening wedge, aka megaphone pattern. So what we're looking at here now, we're on the 1, 2, 3, fourth touch of the top of that pattern. We've already had, at least 3 tags at the bottom. So this is a fully mature broadening wedge pattern. With the potential to break down. At the very least, I could see prices heading back towards the bottom of that pattern. And then a downside break would be extremely bearish, especially, considering that it comes after this extended move up. So, I can't see that far ahead at this point in time, but I can tell you this sets the stage for a much deeper correction, a much deeper bear market at, beginning sometime this year. May or may not happen, but for now, in the short term, the final thing I wanted to mention is we have a very nicely defined uptrend line within what I call a sub-uptrend line or a minor uptrend line. And if you look at this blue uptrend line here, which I'm waiting for a break for a sell signal on the small caps, and add that together with the top of this primary uptrend line, which prices have been backtesting, well, that's simply a bearish rising wedge pattern. So what we're looking at here are 3 different things. Prices being at the top of a megaphone pattern, aka broadening wedge. Prices recently breaking below a long-term uptrend line, and also wedging up now within a bearish rising wedge pattern. We have negative divergences below the megaphone pattern and the bearish rising wedge pattern as well. So, there's enough technical evidence there. And all we need is that spark, that sell signal, and that would be a breakdown below this uptrend line. So if and when that comes, I think there's going to be quite a lucrative short to be made on the small cap stocks. So something to keep an eye on. Okay, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.